Investing in the stock market isn't about luck or gambling. It's about hard work, knowledge, and skill, just like achieving anything else. To succeed, you need to be consistent, committed, and have a long-term plan to avoid making mistakes. Stock trading is more like brain surgery. While it might seem risky to perform brain surgery, a skilled expert does it with precision, just like a successful stock trader. After watching this video, you will learn how to become a skilled investor. So, let's get started. In 2009, you might have seen an opportunity to buy shares of big name companies at incredibly low prices. But these low prices could also have been a sign that these companies were in trouble. During the financial crisis, American International Group's stock price plummeted from $103 to 33 cents in just 2 years, and it was removed from the Dow Jones Industrial Index. Citigroup faced a similar fate in 2009, and General Motors' stock price dropped by 95% that year, erasing decades of value and leading to its removal from the Dow Jones Industrial Index. The lesson here is that the stock market doesn't care about a company's reputation, it's all about its performance and growth. Don't invest in a failing company just because it's a well-known name. Many such companies belong to the past, and the future may belong to lesser-known companies. Have you heard of the cockroach effect? When you spot one cockroach, there are probably more hiding. But this concept can be applied in a positive way to the stock market. If a company's quarterly earnings exceed expectations, it's a good sign. A company on the rise can indicate a growing industry worth watching. This attention and potential success can attract institutional investors before the actual results are out, which can boost earnings. If the speculation is correct, the numbers will likely continue to rise in the next quarter. On the flip side, this contagion effect works for negative surprises as well. Companies that consistently miss their profit estimates often continue to disappoint. So, when building your list of potential investments, focus on companies that have consistently beaten earnings expectations in recent quarters. In simple terms, avoid companies with a history of negative surprises and invest in those with a positive growth track record. This advice might seem obvious, but I will explain why it's more counterintuitive than you might think. Beginner investors actually have some advantages that could help them outperform the experts. Here's rule number 1. Don't pay too much attention to the professionals. These words come from Peter Lynch, who's known as one of the best money managers ever. He achieved impressive results, growing his Fidelity Magellan Fund by about 29% each year for 13 years. So, it might be a good idea to listen to him. Contrary to what you might think, people who manage money for a living don't have a significant advantage over individual investors. One major drawback for large fund managers is that they need to buy a lot of shares for their portfolios, and that means they require a lot of available shares. This limitation is a handicap because it makes them less flexible. Promising superperforming stocks tend to come from smaller, more agile companies with fewer available shares. Moreover, big fund managers often have to invest in companies approved by their board committees, and they need to justify their choices to them. These committees usually prefer well-known safe companies like Google or Apple. So, fund managers often play it safe. If these safe shares drop in value, they can simply blame it on the whole market having a tough time. As they say on Wall Street, nobody gets fired for buying IBM. In contrast, individual investors don't have a committee watching over their decisions ready to fire them if they take a chance on a smaller, riskier but promising option. This freedom allows individuals to take advantage of market shifts and opportunities. Plus, with today's technology, you have access to the same tools as professional traders, and you don't have to stick to conventional choices. Following the crowd and staying on the well-trodden path won't make you rich. Now, let's discuss what to look for to make exceptional investment choices. Mark Minervini's special entry point analysis strategy is a method he created based on 30 years of real trading experience and historical data about the stock market. It's not just about a stock's value, it also considers how quickly the stock is going up and what's driving its growth. In the stock market, time is money. Now, let's get into the important parts of SEPA. We already know the basics. Look for companies whose value is clearly on the rise, seen in their growing revenues, profits, and margins. But what sets apart companies with star potential from those that actually become stars? Superstar stocks are ignited by something special, like a new contract, or a hot product with strong branding. Think of Apple's iPhones, Microsoft's Office Essentials, or Google's ubiquitous search engine. These are well-known examples, but we're actually looking for relatively young companies in their first decade after going public. In the early 1990s, Minervini focused on trading lesser-known companies that were showing strong growth and demand. Most investors are wary of companies they haven't heard of, but that's the opposite of what you should do if you're seeking the next superstar stock. Once you find a stock with star potential, there will likely be an opportunity to buy it at a lower risk price before it takes off. Timing your entry is crucial. Get it wrong, and you could face significant losses if the stock drops, which can happen. But if you get it right, it could be a big win. This leads us to another key aspect of SEPA, which is knowing when to sell. Not all high-potential stocks will result in huge profits, even if you timed your entry perfectly. So, it's important to set stop-loss points, specific points where you decide to sell and protect your money. And remember, at some point, you'll need to sell the stocks to make a profit. Do you have what it takes to do well in the stock market? The answer is yes. The stock market itself isn't your biggest enemy. In fact, if you don't take yourself seriously and put in the time, belief and attention this task deserves, you might be the biggest obstacle to your success. Looking at the odds of success, consider the pioneering trader Jesse Livermore. During the stock market crash of the 1920s, he could have felt hopeless, but he succeeded. Let his words remind you. Wall Street never changes, because human nature never changes. As you begin your trading journey, don't get too hung up on the price-to-earnings ratio, which is the stock price compared to the company's value. Typically, investors tend to avoid stocks with high PE ratios, but that's not always wise. Minervini has found that potential superstar stocks often grow quickly and might demand a higher price when you're looking to buy. Don't let this scare you off. If a company is at the forefront of exciting developments and about to take off, the price will reflect that, which can be a promising sign. In the 1990s, it was hard to predict the internet's rapid growth and the value of tech stocks. Minervini bought shares of Yahoo in 1997 when its PE ratio was very high at 938 times its earnings. Yahoo wasn't well known back then and many other investors hesitated to buy it. Over the next 2.5 years, the company grew by 7,800%, with its PE ratio soaring to over 1,700 times its earnings. Investing in even a small portion of that growth would have been a significant win. This teaches us an important lesson. The PE ratio reflects market sentiment. It shows how the market values a company's earnings at the moment. So, it's a useful gauge. A high PE means high expectations, while a low PE means lower expectations. Many traders tend to favor stocks with low PE numbers, but that can be a mistake. Focus on the potential for growth and use the PE as a guide, but don't let it overly influence your decisions. This brings us to our next point. Although we're all drawn to a good deal, don't invest based solely on what's cheap. Buying something just because it's a bargain can be harmful. You might find it hard to sell when it drops even more, leading to investment troubles. Instead of hunting for a bargain, invest in companies showing signs of superstar potential. Remember, you usually get what you pay for. Let that both warn and motivate you to do your research and trust yourself. You don't need an advanced math degree to succeed in the stock market. SEPA was developed through years of trial and error, so don't be afraid to learn from your mistakes until you find your path to success. Ultimately, no one cares about your wealth and success as much as you do. As Henry Ford said, there isn't a person anywhere who isn't capable of doing more than he thinks he can.